Good afternoon and welcome to this webinar with Castings Plc, hosted by Yellowstone Advisory. We're delighted to have with us today Adam Vicary, the Chief Executive, and Steve Mant, the Finance Director.
Good afternoon, everybody. Welcome to the Castings interim results. Intention is to give everybody a bit of an overview of Castings. Realise people have probably already heard the stories before, but an update of where we are, what's happened in the half year, and an outlook for where we see things going in the future. In terms of the group structure, for those of you who don't know the business and a bit about what we do, we are an iron foundry, machining and assembly business. We're basically a company that makes stuff, and we do it from three different sites, two foundry sites and one machining site, which also is starting to do some assembly as well. Each site is broadly the same number of employees. Two of them are based in Brown Hills in the West Midlands, and one of them is based in Dronfield in North Derbyshire. The plant and equipment that we have is all very modern equipment. Some equipment available for making fairly high volume parts, and some for less volume parts. There's prototyping facilities, computer simulation of casting, and the group really is a great amalgam of some traditional processes which you have to have in the foundry industry, and some really high tech automation and even AI. We now have over 50 robot cells within our organization, and that's planned to continue to grow over the coming years. So if I give a brief overview, you can read the text, but I'll sort of give it from the horse's mouth, as it were. The first quarter of our financial year, April, May and June, were kind of like business as usual pre-COVID. Good levels of volumes, profitability back to where we'd expect it to be. The only real issue that was impacting the P&L was rapidly increasing steel scrap prices, which we do pass on, but there's a time lag. So the first quarter was pretty good. We got to the end of the first quarter, literally the last 2 weeks of June, and we were notified by our biggest customer that they were closing one of their assembly lines for a period of a number of weeks. And this pattern has continued basically ever since. So in the second quarter, whilst we had very high schedules which related to our customers' desire to build trucks, they weren't able to achieve those schedules, so we didn't get the call offs, i.e. our dispatches didn't match it, simply because they couldn't get other items in the supply chain to keep their assembly lines going. You've probably all heard the issues of semiconductors, but it was cited as semiconductors, steel products and rubber and resin products. And the situation has continued. The demand for trucks is very high, but the conversion of the schedules to actual sales for us is basically all over the place. Just where we sit at the moment, customers have adjusted schedules till Christmas based upon what they believe their best case scenario is on supply chain constraints, which has given us a little bit better chance of planning. But then in the new year, the scheduled demand is actually eye-wateringly high. Whether or not they'll achieve that, we're somewhat skeptical of. But that's meant that we've kept our production levels pretty high. We've carried high stocks. Steve will give a bit of an overview of where that is. Particularly in the first half, we're probably producing at the moment at or about the level of demand, maybe still stock building a little bit, but we're trading profitably, but not at the level we wanted, purely because of the constraints on the supply chain to our customers.
Okay, good afternoon, everyone. Just set out on this slide a 5-year headline numbers, if you like. Clearly, the last period was or September 20 period is not a good comparison due to COVID. Hence, we put some other years on there. So really, as Adam said, the sales weight volume levels were particularly in Q1 back to the normal sort of levels, and Q2 was much stronger than the COVID volumes. So that's resulted in revenue of just shy of 70 million there, so comparable to September 18 and 19. Adam mentioned about steel scrap, that because that time lag in passing on those price rises, which have continued pretty much month on month throughout the period, has meant that we lose some profit, and that amounts to about 900,000 in the 6-month period. So that profit before tax of 5.4 at a 7.8% margin would be more like an 8.9% margin if you added that steel scrap effect back in. So again, more comparable to previous periods. Just also on there, mention the dividend. We've increased the interim dividend by 2.5%. We do see ourselves as a progressive dividend company. We have increased it pretty much every year over the last 30 years or so. So that's important for us. And then overall there, a net cash position at the end of the 6 months of just shy of 35 million. And moving on to the next slide, just gives a view of the Foundry Weight, which is obviously a key driver for our revenue and profitability. So in that, overall for the 6 months, we're at 24,300 tons in the period, which again, as I say, is comparable to September 17, 18 and 19. And the chart below just tries to give it on a quarter by quarter basis to give a bit of a flavour of it. So you can see in that Q1 and Q2, the blue bars are at or around the average of the previous 5 equivalent quarters, excluding the COVID 2 quarters. So a decent recovery, albeit Q2 you can see it's slightly below the levels of the blue bar that's closest, or the lighter blue bar that's closest to it. So not quite at the volumes we were hoping and we were seeing previously. The next slide just shows commercial vehicle heavy trucks are a big component of our customer base. It's about 70% of our revenue, and most of that is to European OEMs. So we just show there the heavy truck registrations in Europe to just give you a flavour of where we've been over the last sort of 15 years or so. And you can see there the drop in 2020 as a result of COVID. And then we've got Volvo in their quarterly results put out an estimate of where they see the calendar year registrations being. So you can see on there in 2021 they're saying 280,000, and then in 2022 they're suggesting an increase to 300,000. So a steady return, albeit not to the peaks of 2018 and 2019 just yet. Moving on, there's a couple of slides splitting it down between foundry segment and machining. So again, at the top there you can see sales weight as on the previous slide, so back to the normal sort of levels. We've set out an average selling price on there. A couple of key movers on impacting the average selling price will be around the mix of work that we sell. Now that can be what we call a raw casting, so it can be a casting that we've just produced and not done any more processing to than that, or a machined casting is at the other end, where we will have machined it in the machine shop, and we may have done some assembly as well. So the mix in those two has a large bearing on the average selling price. We have seen steel scrap prices increase, as we mentioned before. That has played through to part of the period where we have So the first quarter's increases have come through in the second quarter, if you like. So that's pushed the average selling price up. But that mix between more complex work and the more straightforward raw work has shifted back down a little. So that's kind of offset. So we've seen a slight reduction in the average selling price. So the Foundry external revenue as a result, 68.1 million, and a segmental result of 5.3, so 7.1%. Again, the steel scrap impact, if you added back that 900,000, you'd be at 9.1% margin, which would be again more akin to the September 18 and 19 periods. Then in terms of machining, so break-even position for the 6 months overall, but it really was a game of two quarters or two halves. The first quarter with volumes being good, the machine shop generated a return of 6% on total sales. It is a well-capitalized business running a high depreciation charge. So when those volumes drop, it's very hard for it to turn a profit. So that profit that we saw in Q1 was all but eliminated in Q2. But importantly, it generated cash of just shy of £1 million in the year, in the 6 months. So then just giving an overall cash flow position for the 6 months of the whole company. Depreciation, you can see a slight drop there, and I think it's important to note that that is a declining number. The investment levels that we foresee for the next sort of 5-year period, we would expect to see that depreciation number drop probably to the tune of 2 million over the annualized period in about 4 years' time, but a steady drop over that period. You can see working capital outflow there, as Adam mentioned, the stock increase that we've seen in the period where we've maintained production to try and maintain efficiencies, but sales volumes have not been at the same level. CapEx, so we've spent 2.4 million in the period. Again, slight reduction. We foresee that being at sort of 4 to 5 million level, annualized over the next 4 to 5 years, really. So that is reducing. But put on there advances to pension scheme of 1.1 million. As you may be aware, we went into a buy-in on the pension scheme. So that was back in March 2020. So the pensions are effectively paid for by Aviva now, albeit the company is paying them at the moment and recovers it after the period ends. So there's 1.1 million that we've paid out that will be recovered. And then with the dividend of 5.1, the overall net cash outflow of 1.4 million for the period.
So if I give you a bit of a flavour of the market and what's going on with that, our core business is truck, but it's really heavy truck. So these are the large trucks you see on the roads, where the powertrains are typically 9, 13, 11, 16 litre powertrain. So it's the heavy end, the long haul is where our business is at. It's about 70+% of what we do. And then it breaks down into some automotive, which is sort of passenger car stuff. A lot of that is legacy business, which it's not a sector we're particularly striving to increase, but there's an element of it there. We still make parts for Toyota and a few bits for JLR, but it's not core business. Now, on our other business, has actually been pretty strong this year. All sectors, agriculture, railway, and wind power, where we're seeing some really good opportunities going forward as well. So that'll hopefully increase as the automotive sector reduces. In terms of the geographic split, as Steve said earlier, the vast majority of it goes to Europe. Our US business, which we started to market quite heavily maybe 7 or 8 years ago, and engage with a sort of agent and so on and so forth. And we've seen some really good growth. It's a shame with the pandemic we haven't been able to visit for a while, because we found that business in the States, particularly for our more technical products, which is what we supply to the States, generally requires for a face-to-face meeting of engineers and so on and so forth. So that's all kick-starting again, and we see further opportunities with the American market. So in terms of the future, we have a lot of very good projects that we may have mentioned this to some of you guys before, that are coming to fruition. Scania is launching a brand new engine. It's a combustion engine, planned for the next 10 years, can run on biodiesel as well. It should have been launched by now, but with all the constraints and so on and so forth, it's been put back to what now appears to be spring of 2022. But it's quite good for us, because we've got more product on the current engine than the engine it replaces. But not only that, this particular engine will be used to supply MAN volumes from 2024. So we've got more product, and there'll be more engines. And that engine platform was put down for 10 to 15 years, I would suggest. So that should be coming on stream next year. In addition to that, if I sort of jump to the bottom of the slide, in addition to that, we've got some very novel new business, particularly with Volvo, where we're supplying a complete system for the first time, and it's where we're jointing the manifold system on the engine. If you imagine on a very large engine block, sort of yay big, you can't manifold the exhaust gases with one manifold tube. They have to be in sections, and when you make the sections, you then have to joint them so they can expand and contract within each other, and that causes what they call fugitive fume emissions in the life of the truck. And it's an ongoing battle that truck manufacturers have. And one such solution is to provide a stainless steel shroud that can move backwards and forwards, and it looks like a sort of bellow, and to laser weld that in place. And it's business that we're currently supplying samples of. The equipment's arrived here in the last month or two, and we're quite excited by that new business. So that's what's going on in the truck market. I'll come on to the electrification thing in a minute or two. The other sectors, as I said before, all going very, very strongly, and include battery electric vehicles, which is typically at the end of the truck sector where we've typically not supplied. We're now making products that go on to battery electric vehicles, which are at the lower end of the truck market in terms of size-wise, that we would have not normally have supplied. The reason for that is the battery structures are very heavy. They need high integrity ductile iron to hold things in place, and that lends itself to our product portfolio. So we are starting to produce some battery electric brackets, albeit at fairly low volumes, as you can imagine at the moment. In addition to that, we have been in the process of potential M&A with Aluminium, and we continue on that track. We see that as a good bedfellow to our cast iron range, particularly in the period of truck electrification, which incidentally for our vehicles is 10 to 15 years away before we start to see any significant incursion. So in terms of the future, we don't really know exactly what routes is going to be used to drive heavy trucks. There are a number of technologies that are being pursued. One is obviously battery electric. One is hydrogen fuel cell, which for information, you're probably aware, a hydrogen fuel cell is basically a smaller battery and a hydrogen fuel cell to power that battery. So you get longer range with a hydrogen fuel cell, and the battery itself is much smaller. The argument goes that you get the range, you can have more power, and in terms of the total carbon emissions of a battery electric and a hydrogen fuel cell electric, the hydrogen fuel cell is much less of a carbon in terms of carbon impact. Scania seem to be looking at the battery electric route. Volvo and Daimler have invested in a joint venture called Cellcentric, looking at hydrogen fuel cells. JCB, interestingly, are looking at using hydrogen in an internal combustion engine, as are DAF Packard. So there's a number of technologies. We don't really know yet which one will be the winner, and I suspect it'll be an amalgam of various technologies for quite a long time. And of course, the biodiesel combustion engine on heavy trucks will be the last of the road-going transportation systems to be electrified. So these are some of the things that our customers have said, and you can read that. I won't read those out. You can find that on their websites, or it's when we've been to meetings with them. That's what they've been saying. So environmentally, people may or may not realise that we are a recycler of scrap. We don't use any virgin material. We only produce our product from scrap metal, and then we adjust it metallurgically to give the quality of iron that we need. We only electric melt, which is a lot of our competitors, particularly mainland Europe, still use coal-fired methods to melt iron. It's actually metallurgical coke that they use, but it's essentially a refined coal. And we were able to contract our electricity for all of our businesses on a 100% renewable basis. We weren't able to do it on gas, but that's something we're looking at when our next contract comes in, which is due in 2023. We've done a heck of a lot in terms of reducing waste and seeing waste as byproduct, and we've bought a number of products to be able to use in-house. For instance, when we machine parts now, all the machine swarf is collected, it's cleaned, the cutting fluids are reused, and the metal is compacted under hydraulic pressure such that we can reuse them in a briquetted form. In terms of our customers, they're working with us to see where there are opportunities where perhaps we supply a casting that is then machined, it's shipped to somewhere in Europe to have something done to it, then somewhere else in Europe, and then somewhere else for various things. And we've got a number of projects ongoing at the minute to reduce the carbon miles on projects. That's a real opportunity for us at the moment, and we've got some really nice projects coming through where we've been able to demonstrate significant reduction in carbon miles by bringing all the processes in-house. So in summary, I might do this or you do.
Yeah.
Okay. In summary, we're a business with a strong balance sheet. Some might argue too strong. We've got very good opportunities in our current markets, particularly on the next generation trucks. We anticipate a progressive dividend policy going forward. Steve has already mentioned the pension, that the company will be completely de-risked from the pension within hopefully 12 months, depending if they change the rules again. And we remain very agile and able to take the opportunities that are in the market. So thank you very much.
Adam and Steve, thank you very much for that presentation and explaining this, as you say, that the tale of two quarters. Sounds like things definitely took a step back in Q2. Let's hope things are recovering as we go into Q3. We're now going to take questions. And just a reminder, if you do want to ask a question, please just type it into the chat box at the bottom of your screen. We'll start off with a question here that's come in, which looks about or talk towards net zero. Under the new Treasury rules, by 2023, companies will have to set out detailed public plans for how they will move to a low carbon future in line with the UK's 2050 net zero target. Will this include you, and how will it impact you?
You've got it.
Yeah, I mean, it will include us, and that whole narrative which we started to talk about in last year's annual report around the ESG approach and how it impacts us. That's something that we will be building on in the next annual report, as we tell the story, because actually we have a decent story on that aspect, and perhaps people don't realise it, given the nature of the industry that we're in. So yeah,
it's a very good point, and we're lobbying quite hard at the moment, our industry, because we made the transition to electric melting a number of years ago. Pretty much the whole of the UK now is in electric melting, unlike our European competitors, and so much so that provided we can source our energy from renewable sources, it goes a long way towards being part of the net zero solution. You know, at the end of the day, we're big recyclers, and we're no longer using, well, here at Castings, we took out fossil fuel sourced melting in the 1970s, and it's somewhat ironic, you know, that people think of foundries, but actually foundries are part of the solution going forward.
Yeah, thank you for that. Sounds like you're already doing a lot in this front, although like in every area, there's still more to be done. A sort of question here about clarification on the sort of electric vehicle front. Are you currently providing any parts for any electric vehicles? And if so, what parts are you actually providing?
Yeah, I tried to sort of mention this in the main presentation. We're making a number of ancillary brackets for battery electric vehicles. These are for battery electric trucks, not passenger cars. So the first trucks that will go to electrification are the sort of rigid trucks that you see delivering, you know, some bricks onto a brick site in a city, or going and picking refuge up, and so on and so forth. That market has never traditionally been ours anyway, so the fact that's going to electrification hasn't really impacted us. However, because the way in which the battery is fitted to the chassis, there are opportunities for us in that the current small rigid vehicles have typically a fairly small engine, which is not much different to what most people drive around themselves. So the way in which that is fixed to the chassis is very, very simple. It's steel fabrications, very lightweight stuff. As soon as you put a great big battery into the chassis, you've got to hold it with some higher metallurgical strength products, and they're the products we're making.
Okay.
We're making them for Volvo and for Scania. Well, we're actually prototyping Scania. We're actually in production on the Volvo part, so we are actually winning some business that we would have otherwise not have won.
Okay, thank you. Question here: what are you doing to mitigate against falling sales due to trucks moving from internal combustion engines to electric engines?
Yeah, I mean, that's the $1 million question. I mean, we've got very good business for the next 8 to 10 years on trucks, but don't get me wrong, when the diesel engine disappears, assuming it does, and assuming that it doesn't get replaced by hydrogen combustion, we would see a 30 to 35% reduction in our business, because we still have the other business with trucks. So clearly we're mindful of that. Two areas. One, we're looking at more products that are within the truck sector, which will not be affected by electrification. For instance, we've won two new customers one in independent truck braking. So on a truck trailer for large trucks, there's an independent braking system, and we're now supplying parts to that. That is unaffected. That's not affected by electrification. And we're also supplying trailer coupling devices, which you don't see them so much in the UK, but very popular in mainland Europe, where they have a tractor unit, a trailer, a large trailer, and then they have another trailer on the back, and they're coupled between those two trailers. It gives them a higher payload, particularly popular in Germany and France. So we're looking at other areas, but don't get me wrong, there is a cloud on the horizon. It's a long way off. We've got sufficient time to maneuver the business through this period, and we also see the potential for offering new materials, maybe aluminium, where we've been working quite hard to try and find some potential partners in the last 12 months, albeit we've not been successful so far.
That leads neatly on actually to the next question, Adam, which says, can you talk more about the opportunity in aluminium? Is it something that you can do organically? And where ideally would you like to see the metals mix in 5 years' time?
You can do it organically, and there's a school of thought that says that should be the way we go. And I'm becoming more and more interested in the organic route for technical reasons that I probably won't wish to bore you with at the moment. So yes, we can do it organically. We are going to approach one of our major customers in the new year to see if they'd be interested in us putting a facility down on the basis that they're guaranteed to give us some products. The products. So in terms of aluminium, on a battery electric vehicle, the way in which it's connected to the chassis requires high integrity cast iron. We're supplying some of those. But then from the top of the battery, if you like, how do you then fit bits that make the rest of the cab? And a lot of that, because you've got the weight of the battery, a lot of those goods are aluminium. So there's a real opportunity for that. And it makes sense because you want a heavy battery at the bottom of the chassis, and then you can have lighter products at the top. That's always desirable in trucks because of the issue with center of gravity. So a lot of opportunity for it. Can we do it organically? Yes. It's more likely we'll go organic, but we are still interested in a partner if one comes along. But it's just, we had a go at a distressed aluminium foundry earlier this year. It didn't come to anything, unfortunately, and the business has continued to be distressed. We'd like to, but it depends on opportunities. But there is an opportunity for going organic. In 5 years' time, it'll still be, I would say, 95% iron, even if we were successful in getting into aluminium. In 10 years' time, that might be different.
Okay, thank you. Moving to the balance sheet here, you've got a lot of cash on your balance sheet. Could you perhaps explain a little bit about how you're planning to use that cash?
Well, I guess, if it wasn't for the pandemic last year, we would have almost definitely have been distributing an amount of that cash to shareholders. But obviously, when the pandemic struck, everything ground to a halt. And I may have explained some of you guys before that we went into cash preservation mode because we just didn't know how long it was going to go on. All of our customers closed. We had 3 months for virtually no sales. We didn't know how long the whole thing was going to go on. It's left us with perhaps a slightly higher amount of cash on the balance sheet, and the analyst forecast, Steve's view is, excuse me, that it's likely to be circa 40 million by the end of the financial year, give or take. So what do we do with it? At that level, we would almost definitely be into some sort of distribution. What that'll be, the board will decide. But nevertheless, we will be sticking with a fairly high level of cash on the balance sheet for some time, just in case an opportunity comes along to for M&A and or to fund a significant organic growth in aluminium.
Okay, thank you. And just a reminder to people, if you want to ask a question, please type it into the chat box at the bottom of your screen. Got a couple more questions here. Could you explain the pension situation? Will it cost you any more, or is the possibility of getting a cash return to the company from the pension scheme?
I'll have to pass that on to Steve. I normally go to sleep when I get questions like this, but
thanks. Yeah, so as I sort of touched on earlier, we went to a buy-in of the pension scheme in March 2020 with Aviva. So that effectively removes a lot of the risk associated with the final salary schemes, and Aviva effectively are paying the pensions. We're now going through the process of moving that buy-in to a buy-out to then wind up the schemes completely, so remove any risk at all. That process is taking a little longer than I might have hoped. GMP equalisation, I won't go into the details of that, otherwise Adam really will nod off. But it's a new thing that people are having to do. It's a complicated process. It needs consultation. It's taking time. At the end of all of that, I would anticipate there will be a surplus, so there won't be any need to put in any additional funds from the company to achieve that. And you would think that some of that surplus would come back to the company. There is a negotiation process with the trustees at that point, because you have the rules set out the steps that you have to take before any surplus can be returned to the company. But yeah, I would anticipate there being something, albeit it's subject to quite a significant tax charge as well. But certainly no additional funds needing to put in, and I would hope this time next year there will be some coming back.
Okay, thank you. Could you talk a little bit about the third quarter and going into the third quarter? Have you seen any pickup in sales from Q2?
Well, yeah, I mean, the first few weeks of October, we were, it looked like okay again, but it's dipped back to where we were in Q2, I'm afraid. I can't give any real visibility. We had a fairly good October, and apart from the last week, and then we've had Volvo have significantly reduced in the last since the end of October into November. So it's very difficult, to be honest, and I wouldn't like to hazard a guess. But the sales line, we've adjusted our production to where we believe the sales line will be. We're profitable, doing okay, generating cash. It's just not the level we'd like. And as I say, in the fourth quarter, the schedules are fabulous. It would be brilliant, but I just suspect by the time we get there, there'll be further adjustments. And we're not out of this problem yet in the supply chain. People are talking about 2023 before semiconductor supply meets demand, and the passenger car and truck people seem to be at the bottom of the queue for receiving those goods. And steel prices have continued to rise. Every month's another record. And that's largely being driven because there's now shortages of steel, because people are not making the products that give the arisings for steel scrap. Yeah, it's a bit better than it was in Q2. Can I predict it's going to be better? I just don't know. I really wouldn't like to hazard a guess. It's incredibly difficult to follow.
You may not be able to hazard a guess there, but a question here saying, what are your brokers Arden forecasting for the outcome for the year? Do you have those numbers?
Yeah, I think Steve.
Yeah, they've got revenue of 146 and operating profit of 11.2 million for the year.
Okay, brilliant.
And that's borne out by a month like October where everything's gone okay, and then a pretty awful month, and then an okay month, and then it's borne out by that sort of pattern. Yeah.
Brilliant. Okay, well, look, there are no further questions, so that brings us to the end of today's webinar with Castings. Adam and Steve, thank you very much for your clear presentation and for answering all those questions. As you leave today's webinar, you will be asked to fill out a shorter survey, and that feedback is very much appreciated by management. So if you could spend a couple of minutes just completing that, and just to flag up a couple of webinars that we've got coming up in the coming weeks. On next week, on the 24th of November, we've got a webinar with Sainsbury's. On the 7th of December, Lloyds Banking Group, and on the 13th of December, a webinar with Halma. So thank you for attending, and we look forward to seeing you all soon. Thank you.